Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Working with newlyweds or graduates helps RIAs get introduced to the next generation of investors. Joining us to discuss, we have Chris Englebert, founding partner and CIO of Englebert Investment Advisors. Chris, it's great to see you as always. Welcome back to Trade Talks. And this is an appropriate topic considering we're in that May-June period, certainly June. And this is a time for weddings and graduations.
Yeah, it's really amazing, Jill. I mean, June is the month. It's weddings and it's graduations, whether it's high school or college graduations. But it's interesting because we're getting a lot of clients who are calling us and saying, hey, my adult children are getting married. Can you give us some ideas? And many times the adult children contact us because, they're getting married and they're spending their own money nowadays for the wedding, not like, years ago. And they're being a lot more savvy about it, which is good. They're setting budgets, but they need some tips and tricks. And one of the things that we try to tell them is that, once you combine your household, you've got to consider, how the pools of money are working. And many of them don't realize that, hey, maybe we need to up our 401k contributions or, should we be paying down this wedding debt early? One of my best tips is that if they do get cash in their wedding, they should take that on the honeymoon, but if they get any checks, they should have a FedEx envelope addressed to their local financial institution, put all the checks in and send it. Why wait to have those checks not be deposited for a week or two while they're on the honeymoon? But and then graduations are the same thing. I mean, high school graduates, college graduates, they're getting cash or they're getting checks from grandma, grandpa, aunts, and uncles, and they're looking for ideas. They just don't want to spend it. And we say some of the simplest ideas out there are open a Roth IRA. Obviously, they got to have some earned income and they usually have summer jobs. But, again, when you get these cash gifts, let's put them to work. Let's open an investment account. The young people are getting excited about investing. I mean, they realize it's something that they've got to do for their future.
Chris, this might be more of a personal decision than an RIA advice question. What are your thoughts around combining incomes for joint accounts or even filing jointly or separately? Is there any financial benefit to combining them, or is keeping things separate the best way to go?
We're seeing both ways right now, Jill. Typically, having a joint account, I've seen some young couples, they each have their own money and they feed into the joint account for the bills. I've seen others go all in and combine the joint accounts. But one of the things you have to remember, once you get married, if you still have an individual account and, God forbid something happens and your spouse passes away, the other spouse is not going to have access to that money. So, we tell people you got to be a little careful about that because, it's good to have some of your money separate, but probably, combining households, eventually it's all one pot, no matter what.
Why are these new segment of investors important for a registered investment advisor's practice?
Yeah, to me, they're very important. They're going to be the lifeblood for the next 20 years. And one of the things I enjoy about being an RIA is we can run our practice the way we want to. And we made a decision early on that we do not charge for any account less than $10,000, because I'll get a dad or mom calling up and saying, hey, my son wants to, open an account. We don't want to make them worrying about paying a fee being an impediment. We want to help them get all their money to work. But again, what's happening is they're establishing a relationship, and it's a lot of fun on my part because they're asking some really good questions. And what happens is that eventually, through the life cycle of a RIA's book, this money is going to transition to the next generation. And if you're dealing with the adult children, the young adult children, and they see you as an advisor, not only to their money, they're going to keep the money with you and in your practice. But because we've all seen the statistics that almost 80% of an RIA's book gets lost when when one of their clients dies, and the adult children don't have a relationship with the advisor, the money flies out the door. So, we think it's a very important point. And again, it's also a way for us to give back as well.
I think it's wonderful that you don't charge a fee for anything under $10,000. I just think it's the right thing to do. I think larger institutions should certainly take note. But, Chris, to your point, and you and I have spoken about this before, especially when it's young adults that are coming in, they're not only going to you for financial advice, they're looking at you as a life advisor, almost a life coach. And that's, you could really be a lifelong partner for them. So I think your approach is fantastic. Let's take a look at the technicals here, because we've had quite a month since last time you and I spoke. Let's go to the S&P 500, hitting 52-week highs. Haven't said that in quite some time.
Yeah, I mean, again, we always talk about the old adage, sell in May and go away. You definitely didn't want to sell in May this year and go away. Earnings are still good. The S&P 500, some of the bears are saying it's being driven by a handful of stocks. But again, price is price. And if the index is higher, the index is higher. This is beginning to create a little bit of trouble, though, because, we run diversified portfolios at our shop. And, when you get a narrow group of stocks leading the way, you have clients going, hey, the S&P is up 14+% for the year, and we're not. What gives? And you got to do a lot of education and explaining. However, in the last couple of weeks, we have seen all equity portfolios, do better. And we'll have to see what happens the rest of the year. Hopefully, we haven't peaked for the year, but we're trying to tell clients we have reached the upper range that I forecasted for 2023. We've been taking some money off the table, trimming extended positions. I don't think you're going to see, big pullback, but a 5 to 7% pullback could literally happen at any time.
And of course, Nasdaq 100, we have to cover that. I mean, that's really where the key 7 to 11 names, let's call it, is driving performance.
Yeah, and our model kicked in. We have models that we run for clients, and in May, our model kicked in the Nasdaq. I was a little surprised by that. I shouldn't have been, because obviously its relative strength is so good. But one of the things that you have to remember is that relative strength begets strength. This trend could continue on. A lot of people, try to pick a top, and we think that's kind of dangerous to do. So, like I said, our model's rotated, and we have exposure to the Nasdaq. And, it could end up being, so far this year, the best performing index, possibly even for the rest of the year.
Let's talk about the Russell 2000 for a moment, because there is a market adage that when the Russell 2000 performs well, that's a sign that the economy is performing well. But I mean, Chris, the Russell 2000 really hasn't participated much in a number of years.
Yeah, it really hasn't. And I still think we're in this transition. I call it the 1980s transition, where in the 80s we had higher energy prices, higher inflation, and one of the things that happened in higher interest rates, one of the things that happened is it took a while in that decade for investors to realize that small mid-cap stocks were the place to be. And I think what's happening is there's so much limelight on the large cap tech stocks that the earnings that are doing well in the small cap tech area and the small cap index areas are kind of being overlooked. So there's been a lot of data that's been coming out showing that if this is a true kickoff to the next bull market, you could see a period of outperformance. And that's one of the things we've been saying now for almost a year and a half. Eventually, with the valuations, we believe it's going to come to fruition.
Let's talk about crude oil for a moment. I mean, this has certainly been helping with the inflation readings since prices have been depressed.
Yeah, and this is a big winner, we think, for the consumer as well. I wouldn't be surprised if the oil prices kind of go into a trading range here after their big decline last year. But everybody's looking for a lot higher oil prices, and the chart is the chart. The oil prices have stayed sub $70 or right around $70 a barrel. And it's really helping the consumer. And one of the things that we put out in a monthly piece that we do is we were talking about how all of the commodity inputs to inflation have been coming down. The agricultural prices have been coming down. The energy complex has been coming down. It's the wage side that's still holding up some of the inflation numbers, although obviously the inflation numbers have literally dropped in half since last year.
And finally, let's take a look at the 10-year Treasury. The Fed may have paused, but you're still in the trading range here.
Yeah, and we've been saying this for a couple of months now. We float higher on the 10-year to 3.8. We come back down to 3.5. We actually think the fixed income could go back to be its old boring self. I mean, up until last year, fixed income wasn't really, a sensational asset class to be in. Last year was sensational for the wrong reasons, but now we think it's going back to being a boring place. Now, one of the things that we think investors have to be a little bit careful of, I get a lot of notes from different investment firms, and they're saying, don't fall into the cash trap of, only staying in the short end of the curve, like 5.75% or 5.25% for bank CDs. I kind of have to disagree with that. I do believe you could see short-term interest rates stay higher for longer. A lot of people are looking for them to back off by the end of the year. and they just may not. And we believe that they don't.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.